All right. Good afternoon, everybody. Today we have a special guest, Randi. It's coming in. She's an educated teacher. She's the president of Ono Distribution, and I was just having a conversation earlier with her. Ono Distribution actually distributes wealth and knowledge, and it's awesome. We're going to talk about that. She's been their president for 4 years now. She has a bachelor's degree in international global studies, and she's a financial educator and advisor. And I want to take a minute and say thank you, Randi, for accepting my challenge. I know you're talking about very serious stuff that people use in syndication and multifamily. And we're going to have a friendly conversation today. Just want to debunk a couple of things that I really don't know. And I think our listeners are going to be more than happy to learn about today. Thank you for coming in today.
Happy to.
All right. Without further ado, Randy, I'm gonna jump right in it. I took some notes and I have a couple questions that I want to ask you. And I think we should start with how do we meet? Like, do you remember like the circumstance?
Yes. So we met on a random call. I actually just didn't know until recently that you were not supposed to be on the call. It was a mastermind call for a multifamily group called Legends Equity Group. And one of my clients, his name is Alexis, he hosts this call for bilingual people, Spanish and English speakers who are interested in learning about different concepts for multifamily real estate investing. And he asked me to join the call to talk about different concepts in terms of borrowing from retirement and life insurance. And you happened to be on the call and asked some really great questions. And then we worked together afterwards.
Yeah, that's great. So there are a couple of things that I had no idea that are going to happen there. I joined a Spanish speaking interview, as far as I know. I ended up listening to the whole entire interview with you because I got dragged into the amount of knowledge that you dropped into that call. And I was intrigued about the subjects because there are things that I keep hearing around and most of the people do not know about it, and now including myself. Investing with 401k. It's something that I'm advertising a lot because I do have clients that are actively doing that. What's behind it, I don't really know. What I know is that the market on that space shifted a little bit. For the past few years, people are losing money. But historically speaking, 401ks are doing about 10%.
Yep.
In the commercial space, 10% return a year, it's good, but it's not great because in the syndication models, we usually go for 20%, where the shooting number for most of the companies that I work with is about doubling the money in 3 to 5 years. So it sounds unreal when I'm talking about these things because the rules in real estate and rules in investment, when somebody promises you 10% or more a year, you should run away.
Yep.
That was what I've known for a very long time. But now we're debunking the 1% of the 1% of the 1%. So now we're bringing it to a different level, and we're penetrating this world thanks to you and your knowledge and your understanding. And I'm going to go right ahead, and I just want to find out more about the company that you're running, because I read a couple of things in your bio, and then I went into your actual website, and I checked out the financial educator and advisor. So I just want to know if you can, in a few words, tell us a little bit about your company.
Yeah, absolutely. So I am a financial advisor. I provide all kinds of financial planning, basically a one-stop shop for everything besides taxes and health insurance. And I broker for about 200 different companies. So I myself am not a broker. A broker is an entity, but the companies I'm attached to have a platform of over 200 companies. So I work with all the big major brands, right? Fidelity, Franklin Templeton, Invesco, Allstate, Progressive, Rocket Mortgage. And I work with all their products and services to service my clients. My personal LLC is Ono Distribution, and I actually haven't even told you about this yet, but Ono Distribution is specifically for passing referrals amongst professionals. We're launching a new website in the next couple months that's going to be for that, a free platform for users to use to send referrals back and forth. So I'm really excited about that, but we've just been word of mouth up to this point. So we have a lot of referral partners out there just to help uplift everybody in business. But Ono Distribution, that's what that is. That's my business. And that's what I use to drive business back to the financial planning that I do.
Wow, that's awesome. Yeah, thank you for telling us. Um, Now, how do you become a financial educator and a financial advisor? I do see here, and I just want to mention one more time, that you have a bachelor's degree from International Global Studies, Miami University, and you also have a master's of science at John Hopkins
Mhm.
University School of Education. So I just want to roll back a little and see how was your journey and how did you end up here?
Yep. I previously was a school teacher, so I really enjoyed education. But while I was teaching, I learned that teaching I was a part of a system that I really didn't have a lot of control over. In fact, one of the last years that I taught, I was teaching my third graders about entrepreneurship. And the principal told me I had to stop because it wasn't a part of the government given curriculum. And I had only been teaching about that because I was in a community where the kids were coming to school and saying, our parents don't have jobs, right? There's no jobs. So I was like, well, let me teach you how to create jobs, right? Because that's what you're going to need. That's a realistic idea. And that really propelled me into becoming a financial planner because I knew that my students, in order to help them, they needed more than just a government given curriculum, right? They needed understanding about finances. Their parents could be uplifted if they just had the knowledge, which for whatever reason, we don't teach about finances in our school systems like I think that we should. And I was recruited by the retirement people at the school system that I was in. And at the same time, I had received a message on LinkedIn actually from somebody randomly asking me if I had an interest in working in finance. So I went around and did a bunch of different interviews at different financial companies and ultimately decided I'd like to go down a route where I could open my own office and I have a team of 20 advisors that are on my team. So I wanted to be able to bring other people with me and not do it on my own and just be a solo self-employed. I wanted to build a business structure, and that's how I fell into it. And I wanted to retire early, honestly, was another thing that I really wanted. So I wanted to learn how to do that. So I did that, and it's been about 3.5 years since I started that.
Wow, that's amazing. I heard you speak about your retirement goals, and I'm going to dig a little bit into it. I know you had a big number by a certain age. Is
Mhm.
that right?
Yeah. Yep. I would like to be fully retired and ready to go by age 32. 35 at the latest is my stretch goal. I'm 28 right now. So I have 5 years to create a passive income that's going to pay me so that I can then choose to work rather than having to be forced to work for money.
Wow, that's amazing. Well, with your knowledge and experience and expertise right now, I think that's definitely doable. You're definitely on the right path, and you're teaching us how to do it as well. So I really appreciate you taking your time again to be here with us.
Thank
Uh,
you.
I just I'm using the 401k right now, and I want to start, if you don't mind. I want to start with the different retirement accounts and the investment options that we have nowadays.
Yeah, I'm happy to talk about that. So there are several different retirement accounts that you can use to invest specifically in real estate. And those would be a Roth IRA is something that you can fund up to 6,500 a year right now. That changes. So this year that was a change from 6,000 to 6,500 for the year, or 7,500 if you're above age 50. That is money that you can put into retirement account where you will not have to pay taxes on it when you go to use it at retirement because it's post-tax money now. And the contributions are accessible at any time without penalty. So the growth you have to wait until 59 and a half to use, although there's ways around that. But the contributions you put into there are completely accessible. So that would be one retirement account that you could use to invest in real estate. Another one would be a 401k, but there's different versions of 401ks. So there's a 401k that's at an old company, right? Someone that you worked for previously. There could be a 401k at a current company that you work for. You could have a solo 401k, which would be one that you own personally because if you're a business owner, then you have access to a solo 401k. And there's differences and nuance to each one. An old 401k from a previous employer really is not good for anything. Because you can't take a loan from it. And the only way to use it would be to liquidate it, in which case you'd have to pay the 10% penalty plus taxes, which I wouldn't recommend doing. So an old 401k, no matter what, you want to roll that out. But where do you want to roll it to is the question. If you would like
Yes.
to use it for real estate, I would probably not roll it into a traditional IRA because there's less options for using it. I would roll it into your current 401k at your job, or I'd roll it into a solo 401k. The reason being is because a current 401k, there's different rules depending on the company that it's with. but you can pull typically up to 50% of the account as a loan up to $50,000. Now, it was $100,000 during COVID. Now it's back at 50,000. So this is something that changes all the time. Right now it's 50,000. And then you pay that back with interest to yourself. So unlike a life insurance policy, for example, you'd pay back for interest to the insurance company to borrow the money. In this case, you'd pay back interest to yourself. So in multifamily, that would be great because you can invest in multifamily and there's a set period of time. So you know I can pay my loan back within this period of time plus the interest because you're going to make more than the interest on the multifamily investment than you would on the interest that you're paying back to yourself into the retirement account. Ideally, conceptually, that's what you'd want to do. So solo 401k, same deal there. So those are some just different ways that you can borrow from a retirement account. And then one way that's going to be slightly more complicated, I can't remember the term for it. The Roth conversion ladder is what this one is called. If you have a Roth IRA that you would like to pull from, a traditional IRA that you would like to pull from prior to age 59 and a half, what you can do is convert the money that's in there to Roth. So from traditional to Roth, 5 years after that conversion, that money is then accessible to you because it's considered a contribution to your Roth IRA. So it's accessible without penalty. So if you have a traditional IRA already and you would like to use it for real estate without having to pay the 10% penalty or taxes, convert it to Roth. When you do the conversion, you'll pay the taxes on the amount that you convert. So you know that.
Okay, that's something that I remember we had a conversation about my pension and about my annuity.
Yes.
When you asked me the question, you want to take the money out right away or you want to wait 5 years?
Mm-hmm.
I remember that part of the conversation. Yes, thank you for touching on it. That's really important. Like I have lots of people that are looking to invest their 401k and the first questions are coming out like, how am I going to pay penalty taxes? How much is going to be? And who do you recommend? Do you have any specific companies that you work with that you recommend right on top of your head? I know I'm just throwing a curveball out there.
Yep. For a solo 401k, I use July Services. They're really good. For a 401k, if I'm setting one up for a company, for example, I would use Fidelity if they match the qualifications for how much you have to have a certain number of assets within the 401k plan. For a Roth IRA, I love using PFS Investments or TD Ameritrade, which was actually just bought by Charles Schwab. So it'd be Charles Schwab soon. But there's a lot of different options. I think you can really use any company. The difference is going to be the advisor that you go through and their knowledge and customer service.
Oh, that's good to know. Yeah. So you don't need a pre-existing relationship with them. You just go on their website and find out more information, I'm assuming, right?
Yeah, you could go on the website. I'd recommend going through a person because if you go on the website, you're going to be paying the fees to invest and you're not going to have a person to ask questions to. So if you go through a person, then they can help you along the way and answer all of your questions. You won't have to call an 800 number in order to get any service.
All right, that's good to know because I was, like everybody's doing things online nowadays. I thought it's going to be a lot faster, but I guess using the phone is a good idea at this point. Because like calling brokers, you don't want to send emails out. You got to call them. You really want to talk to a person and ask the questions that you want. Yes, that's really cool. Thank you. What are the pros and cons? I know you and I decided to go with an insurance, and I thank you for that. Thank you for the awareness that you created for me and my family and helping me out now. But what are the options that people consider? Because I have a good friend of mine recently called me, says, dude, I have this insurance agent. He's going to sell me on this policy, and I'm going to be able to use some of those money to invest. Mm-hmm. And my question was like, well, how much money are you willing to put a month into it? And the guy goes, well, I'm just going to do $100. I'm like, that's kind of the value of that insurance is going to be $9,000 in like 30 years. And how are you going to invest that into commercial real estate when the minimum investment is $50,000 or plus?
Right.
So it's not even a conversation there, but there are people out there that put a lot more thinking they're going to be able to use it. Can you please explain us how that works?
Yes, I'm happy to. So this is a very controversial topic, and it shouldn't be controversial because it's factual, but I'm happy to talk to anybody about any true numbers inside their life insurance policy. I actually just recently met with somebody who's putting $72,000 a year into a life insurance policy for the idea that he can then use it on investments. Here's the issue with life insurance like that. life insurance that has an investment portion inside of it, what's happening inside there is, number one, there's a lot of fees. Number two, there's usually loopholes on how you can use it, and there's caps on how much can be earned in there. And many of them, especially index universal life policies, are not federally regulated. So the advisors, or agents, I should say, that propose these life insurance policies are not mandated to show like realistic views. So they'll typically show something that looks even better than, it's a positive projection of what would happen inside the policy. Now, the issue with using the money, the biggest issue, in my opinion, is that if you want to use the money from the policy, you have to take it as a loan. So it's your money that you're investing, and you take as a loan, you pay interest to the insurance company in order to use the money. Now, the argument that you'll hear from some agents about why this still makes sense for you to do is that the money is still going to grow inside the account as if it's there while you're not using it. But the money growing inside the account, it's never going to grow at an interest rate higher than what you're paying to the insurance company to use it. It wouldn't make any sense for them to do that. So ultimately, it's a loss on your money there. The first 3 to 5 years, typically no money even goes to the cash value unless you're way overfunding the policy as well. So you're really just throwing money down the drain. It's to pay off the high commission of the agents that are selling the policies. Then there's a lot of other things I can go into. I don't know how long you want me to go on about that subject, but ultimately, do the math, read the fine print, see it for yourself, call the company and say, hey, what happens? If I pass away, where does this money go? That's a big thing too. The cash value does not go to anybody when you pass away. So you're throwing money into an investment where one day your beneficiary is only going to get the cash value or the death benefit. They do not get both unless you pay extra, which doesn't make sense either. You wouldn't pay extra money just to keep your money. It lowers your effective rate of return doing that. So
just right there, I want to stop you for a second. So you're not actually allowed to get them both. It's either or, and that's in fine print, and everybody reads and signs that.
Yes, absolutely. And these are called cash value life insurance policies. Cash value life insurance has 6 different subsets that you can have: index universal life, variable life, whole life, but they all work a little bit differently. So you got to read the fine print inside your policy. Some will say, one or the other. Some will say you can pay extra to keep both, which I rarely see those anyway. And there's some that you can flip flop back and forth on which you would take if you were to pass away, but it never makes sense to have, if you're paying for 2 things, you should get 2 things. Right.
All right. So if I would be asking you for a life insurance that's going to be beneficial, it's always circumstantial, like based on what do you need and your goals, I'm assuming. So is it better to do a term life insurance for the benefits that it provides, and is a straightforward, simple form application?
Yes. Yeah.
Because I don't really understand the difference between all of them. I know I'm going for a term, and there's a specific reason. My wife is happy if I have a target on the back of my head, right?
Yeah.
For the first time ever.
You really just made yourself more valuable.
Yeah, right there. I made myself valuable for my family, but it feels that way because I don't have it embedded in my culture. Like, I'm coming from an Eastern European country where, we don't even talk much about life insurance, and we're not taking into the account the worst case scenarios. Yep. And now I'm facing with a reality here. Things are changing so quickly. You really never know. And now I want to get protected. And it's not me personally, that it's my wife and my kids. Right. So my why becomes very important. And at this point, it alters my reality and it becomes a need. But what do you recommend for an individual that has no idea about it, heard about term life insurance, doesn't really know how things work?
So the major difference between term insurance and cash value is that, one, there's no investment piece inside of term insurance. So you're just paying for the insurance piece. And 2, it only lasts for a period of time. So in a cash value policy, you have a death benefit that would last all the way out to age 100. But in a term policy, it's going to last for 10, 20, 30, 35 years at the most, depending on your age and what term it is that you decide to apply for. Now, that for some people, they would think, well, at the end of my term, what am I going to do? Because
that's another question. Yep.
Yeah. So how do I handle that? So ideally, the term insurance is a heck of a lot cheaper. than cash value. So ideally, what you would do is you would take the money that you're not overspending on your policy and invest the difference. Buy a term and invest the difference is the idea. So if you have a term policy that's 35 years long, right? You're going to pay for that policy every single month or annually, however you choose to pay for it. But at the same time, you're also going to invest in an IRA or a 401k or in an open investment account to build wealth for your family. So at the end of that 35 years, you no longer need insurance. You would be self-insured at that point. So if you run numbers on, someone who is we keep it apples to apples, right? Same age and health and everything on a cash value policy versus a term policy, the cost of the term and investing, you would have more money at the end of your term than you would on a cash value policy. And that happens every single time. No, there's a couple different pieces there, right? What if you are older and you didn't get the term insurance, right? Or what if you're older and something went wrong, with your investments? Maybe you cashed out, maybe you just fell on really hard times. What do you do at the end of your term? Wouldn't you be screwed? Well, if you have a good term company and a good term policy, make sure you read the fine print. Again, you should be able to extend your term out to age 99 without reproving medical insurability, without increasing your premium payments, but your coverage amount would readjust to your age. So, I know for the policies that I work with for term, coverage amount goes down to about half and declines incrementally every 5 years out to age 99. So it gives you more time to catch back up in those investments.
Well, if I'm 99, I don't think I'll be too worried about it.
Exactly. Worst case scenario, you have your burial expenses fixed up, and that's, you're not leaving a burden on anybody, but it just depends on what your coverage amount is and everything that you have. But it's term and investing the difference makes the most sense.
Yeah, you kind of eliminated the next question that I had about this, because I was like, okay, your term goes out. Let's say the 35 limit goes out, then it renews. And I need to know if there's an option there. Every company offers that opportunity, or it's just certain companies that you work with?
Just certain companies. So it really depends. There's some people that feel, they know beyond a shadow of a doubt, they're not going to need their insurance at the end of their term. So then they'll go with companies that don't offer that fine print. Those companies are typically going to be a little bit cheaper, right? And they don't have as much value, right? So what companies I don't want to name specific companies, but Google, there's companies out there that have their real cheap insurance, but they are missing certain things. Like they don't have a terminal illness rider in there. They don't offer disability. So if you become disabled, the company would take over premium payments. They don't offer any end of term options. They probably have more loopholes for reasons why they wouldn't pay out in their policies. And for some people, that would be okay. I use specifically Primerica term insurance policies. They have a lot of value inside of them for the price that you pay. It's like the perfect value to price, right? As opposed to super cheap and not having a lot of value inside of it.
Now, a question for you. If I already have an insurance policy with somebody else, would you be open to take a look on it and just compare apples to apples? Because it happens that some people already have them. They have no idea what they sign up for. And it's not that they don't understand the fine print. It's just it's hidden in there somewhere. And then right off the gate, another question comes up. How do I figure out the fees behind this? Like nobody gives you a spreadsheet with fees and how they're going to work out year 1 to year 35, the end of the policy, right? So
it is sometimes mental gymnastics to read these policies. I do a lot of evaluations of current policies for people because they are, you just go about life and you try to get life insurance because you want to protect your family or you want to be in a good spot, investment wise. And I don't blame people for getting these policies because the salesmen are really great at making them sound good. So that's a lot of what I do is evaluate current policies that people have. And I'll literally go through and just highlight in the fine print so that people can see it because I know what I'm looking for. And here's what you want to go look for. Go look for the provisions on policy loans. Go, search do a Command F search, right? And just type in the percent sign and it'll come up with a bunch of percents. Go and read the schedules. A schedule is just, the fees inside the policy and what the projections on where the cash value would be and things like that. Sometimes, though, it is not very clear. They'll use 3 different terms for, what they're trying to say. And that's why I step in and I help people to understand what kind of policy it is that they actually have and give them realistic ideas on what the policy is going to look like. But policy loan, that's the first thing I think there's just knowing that you have to borrow the money and pay interest to the insurance company. That's enough for me to say I would never use this
Yeah,
policy.
that bothers me.
Yeah.
That
So find
bothers
that in
me.
the policy. And if you have it, I mean, there, you don't need anything else, right? And then the one thing I do get from people is they're like, well, I've been doing it for so long. I have so much cash value in here. I don't want to just cancel the policy, right? I have, $50,000 in here. Well, if that's the case, you read the fine print to see what your surrender value would be, because you can still take the money out of your cash value. You won't get all of it, but you should get a large majority of it. And a good metaphor for that is, if you had a bucket with holes in it, you wouldn't keep pouring water down it, right? The water's going to
Some
leak.
people do.
So just because you already started doesn't mean you should keep going.
Absolutely. Some people do. In this regard now, what do you do when you do see the holes into a policy and you've been paying in it for a while? Like, how is that transition? You're gonna have to cancel, I guess. So you're gonna take the hit.
Now, I would never cancel it until you have a term policy in place, right?
Okay.
Have another policy in place first, just in case, because I don't know what's happened medically between now and then, last time you got your policy. So go apply for another policy first. Then once you have your new policy in place, then go back and cancel that other policy, and you can take that cash value and invest it.
I had a small thing that happened to me when I was about 28, 29 years old. I had a term life insurance and I wasn't very careful with my cards at the time. And somehow one of the cards expired, then one of the payments did not release.
Mm-hmm.
And few months later, 3, 4 months later, I got a letter in the mail. This was I think I was about 4 or 5 years into it paying. I got a letter in the mail that my policy was completely canceled.
Wow.
And it was no way of reinstating it or doing anything. It was just period, because I never updated. Nobody ever called me about it. I had no idea that really happened with that credit card.
Yeah, that's awful. Someone should have reached out to you. That's definitely on the company and the agent for not reaching out to you, because that's what I was going to say, is that you should have been able to reinstate that.
It was on me more than it was on them. It was a time when I was using multiple email addresses. I've changed my phone number. I was kind of hard to find. I moved multiple times. So it was more on me that was on them.
Yep.
But still, I didn't feel like it was right. And then about 10 years, I struggled with the idea. Like,
Yeah.
I'm like, I don't think it's worth it. If something like this is going to happen to me all over again, like, what am I going to do?
Yeah, no, I don't blame you, because that is a frustrating situation. It's hopefully not a common one, right? That people are experiencing moving that often. And that would be, you definitely want to keep updated information for any investment company or any financial company that you work with.
That was me being completely obnoxious and neglecting that side of my life. It was so easy
Something I
to
would do. So
I was so young and it was under $20 a month. I think it was so easy to do. And at the time, I'm like, okay, it's somewhere in a payment, but I couldn't remember which one it was. But I believe nowadays they probably have 2 cards under the account or something. Like it happens with multiple insurance companies. I think they probably have now by now.
well, I don't know. I haven't actually seen anybody that does that, but there's so many warnings and alerts that go out to the agents. So as long as that agent is still in business, they should know to reach out. Plus there should be, I don't know, there's mail forwarding and things like that to
Yeah.
make
I'm guilty of not using none of those things. That's what I said. It's on me. It wasn't on them, but it was a situation that happened to me that left me thinking if it's even worth getting another one, because I'm like, if this scenario is going to repeat, I'm just going to end up losing the value. Now there is a catch with everything, and I would just put it out there. As you get older and you get pre-existing conditions, then you're kind of slowing down the process, or you're going to limit the amounts, right?
Mm-hmm. Yes. Yeah. The cost of life insurance is based on age and health. So the older you get, the more expensive it is, plus everything that you add on to that. And it's things that you wouldn't even really think about. Your driving record plays a role. If you go to the doctor and you have anxiety marked down, or you take any type of anxiety medication, that can affect it. Diabetes can affect it. Your parents passing away prior to age 65 can affect your life insurance. Pretty much everything under the sun. So if you go to the doctor a lot, they're writing down everything, and it all goes to the Medical Information Bureau, and they do the underwriting through that. So, all your medical records are out there. The sooner you can get life insurance when your medical records are as clean as possible, that would be ideal.
Wow. I was just thinking, I went to GrowthCon a couple of weeks ago, and Dana White, I think it's his name, I'm not sure. He's part of the MMA. He took 10x Health, and I think they're doing it to the next level. One of the guys there, he worked for 20 plus years for the insurance companies, and he was claiming up on stage that the insurance companies, based on a DNA test and a blood test, they know exactly the date that you're supposed to
So
die. And I was like, oh my God, like I want to know, but I don't think I want to know.
I don't know that for sure, but there are a lot of statistics because that's their entire business, right? So I do know that 20% of Primerica policies specifically are the benefits are claimed by people passing away prior to age 50, which is really sad.
So they probably know a lot more than we know mainstream at this point. Thank you very much for all the information on it. I'm not going to dig deeper into that because I don't know much about it. I'm learning about it. 10x Health, if anybody's interested, you can find it out there. But Randy, I have a question. How do we get to you? How do we get an appointment with you, or how can we get on your calendar?
So I have several different ways to get to my link tree, and my link tree has my scheduling link on there. So anyone is welcome to, first of all, send me an email at miranda.pfs@gmail.com. That's miranda.pfs@gmail. Or if you follow me on Instagram, that's at Randy Pants, RandiIIPANTS. That's a nickname from high school, and I won't get rid of it because people know me as it on Instagram. So if you go on there in my bio, you can click my link. It brings you to my link tree, which has multiple people that you can meet with. But one of them is a free consultation with me, and you'll schedule it through Calendly. I meet with everybody via Zoom, but I'm happy to speak with anybody, however it is that they want to contact me. You can even Google my name, Randi McCaughley, and it'll come up with my office, and it has my office phone number if you want to call and be formal about it. That's fine.
Okay, that's great. If anybody wants to connect with you, they can actually reach out to me as well. I have your data. I can send it over. So please reach out if you need any information on it. Like I said, I used Randy for my insurance. I'm working with her, and hopefully I'm going to be working with her from now on this subject. And I'm getting protected. I feel like I'm getting an extra layer of protection, especially now that I'm entering multifamily, and my money need to be protected from all directions, just so my family feels safe. That's one of the things that I'm recommended. Now, if we are new, and I'm asking this because I'm looking for some resources, like where should we start our digging into investments to begin with? Because you are doing that, you're teaching us about investments. And then where should we find some resources on the insurances?
Yep.
Like what would be something that you recommend just for a beginner, somebody that just want to have a light touch base before they have the initial conversation with you?
Yeah. So when it comes to insurances, I actually don't have a good resource for this. Actually, that's a lie. I do. And I'm going to send you some links that you can put in the description of this podcast.
Okay.
Good article for the why not to use index universal life policies, which is really the thing. Here's the thing with insurance. If you Google, cash value versus term insurance, the information that's going to come up on NerdWallet or any company, any website that you find, it is good information, but it doesn't, you can read information all day long, but there's nuance as to how it actually affects you in the long run that is not really spoken about in the majority of the articles that come up. So I'll send you some really good ones that dive deep into the facts and figures inside of these policies so that you can include that. There aren't any books that I've read about insurance specifically, but finance is generally Rich Dad Poor Dad is a great foundation. The 10 most common mistakes. Yeah.
I'm raising my hand. If there are any good books out there, maybe if I can make a suggestion, maybe you can write one.
You know what? I thought about that recently, actually. So who knows? It could be coming. And maybe I just haven't found them as well. That's always possible. The 10 most common mistakes of financial advisors, even if you're not a financial advisor, I think that that's a good book to read to have an understanding on what's going on in the financial advisor's head and really what you can expect out of an appointment. There was another one I was thinking about too. Oh, Tax-Free Wealth, which I know is about taxes, but it explains a lot of the things that I go over when talking about retirement accounts. And it's really great for real estate investors. That one's by Tom Wheelwright. Highly recommend that book. It's an easy read, but it's important information.
I have a question and a distinction that maybe you can help me a little bit. I know it's a controversial subject for many, but financial advisors, are all fiduciary responsible for their advice or are not? Because I get this in the commercial space. My mentors are saying, do not listen to your financial advisor because he's not fiduciary responsible. Just go talk to a syndicator.
Yeah.
So now I don't know the experience of the syndicator either. And I can take the advice based on the knowledge that I have and filter through and then decide. But I have this question to you because I'm really confused. If I go do my taxes and I find out the guy's not a CPA, then I have a problem.
Right.
If I would take advice, financial advice from somebody that is not responsible for the advice, then I'm going to have a problem. So how do we filter this information? Like, how do we get to the bottom of it?
So I was just having this conversation with somebody yesterday. Having that title of fiduciary, which I do technically have that title, does not mean that I couldn't do the wrong thing for a client, quite honestly. Because I'll give you an example of why that is. There is one product that I've been recommending recently to clients that are very specific. It's a structured capital annuity product from a specific company. I won't name it just because I don't know the compliance rules, but it makes a lot of sense for somebody who's between ages 55 to 65, has already built their wealth, can't afford to lose any of the capital, but still wants to earn some income, still wants to earn some interest on it, right? Works great for them. I make a lot of money on it. Full transparency. I have no problem talking about my income. I tell it to my clients as well, just because I want them to understand the whole process and what we're going through. I make great income on that product, and it's really good for specific people. I could very easily sell somebody else into that product, somebody who's my age who would feel more comfortable with their assets being protected, right? And still earning some. But would it make sense for somebody my age? Ultimately not, because you're not going to earn nearly as much interest, because when you have protection on your money, there's caps on how much you can earn, right? So I could do that even as a fiduciary because it is a product that I can legally sell to somebody my age, right? But it doesn't make it right. It's not a good thing. So I think the biggest thing when working with an advisor is you have to build trust, number one. And number two, you have to really dive deep into their integrity. I mean, it's question them on what they're doing. They should have no problem with explaining to you why they think something makes sense, how their fees work, how much money they're going to make from something. That conversation, I think, is important to have. If it's not somebody that you've known for a long time and trust, or, believe in their knowledge of the industry as well. I mean, there's so much that I've learned in my 4 years and ways that I've cultivated, new business because of new concepts that I've learned. I've been able to help more clients of, various different backgrounds and, high net worth all the way down to somebody who only has $25 a month. So fiduciary, right? It's a great concept, but ultimately, I don't know that it really means anything.
I wanted to ask the question because this is kind of the difference that I don't want to put you on the spot, and I didn't mean it to you personally. I just wanted to know how does it play out, and now you gave me a better understanding of it. Because I was always confused. You can't quite ask the question up front. If you go to a bank to get a loan from a banker, you expect he's responsible for the advice that he's giving you. But then when you look at the rates, they don't quite make sense. So then the conflict in my head is, how is this guy giving me a good advice when the rate is this much and it's a better thing for the banker? So I just wanted to take that off the plate. Thank you very much for your time. I still got a couple more questions before we go. What are you reading right now?
Right. Yeah. Okay. Right now, I am reading, what am I reading? There's 2 books and I don't have it right in front of me. I'm 3/4 of the way through the 10 common mistakes of every financial advisor. So that's one that I already talked about. I don't have my other book over here. I can't remember the name of it.
It's fine. It's okay. We're good with that.
Because I knew that question was coming up on here. But that's what I read. I would also recommend a book that I finished recently is Outwitting the Devil by Napoleon Hill. Have you read that book?
No. No, I read a lot of things from Napoleon Hill, but no, not that one. I don't know why.
It's not a religious book. So it's, even though it's called Outwitting the Devil, but that's a really, really great book.
Okay, definitely I'm gonna put it down on my list. I keep Napoleon Hill as a study book. Think and Grow Rich. I go by studying that book. I think it has everything you need in it. It's just you have to keep reading it.
Yep, exactly. You can't forget.
No, you got to go back to that was one of my first books, actually. I started with that, and then I moved to Robert Kiyosaki. He came in very, very quickly and handy with few of his books, and that's how I Rich Dad Poor Dad, and that's kind of how to figure out my difference between assets and liabilities. And for the first time, I had a budget, and I realized that I'm buying only liabilities, and I have no assets.
You know what? I have you read The Power of Now by Eckhart Tolle?
Yes.
My all-time favorite. I have a list of books that I recommend that I have read all the way through on my link tree as well. So if you go on there, there's a whole list of recommended books.
No, that's amazing. Definitely, I'm going to do that myself, and I'm sure that our listeners are going to find, very valuable. Is there one book that you would recommend in this environment of craziness going on? Rates are going up, and people are running to the bank because they're closing. Yeah. Is there something that you recommend as far as a book going, like something that you've read recently that you think is applicable in today's time?
Tax-Free Wealth by Tom Wheelwright, I think, is one of the greatest books. It's a mindset about how to use the tax system to your advantage, because the tax rules were written, or the tax code was written, as a way to incentivize people to do good things for the United States, right? And it talks about how to do that. And I think it's a great book that's pretty timeless in the way that it's written. And the biggest thing to remember right now is we're in a very specific environment, right? And we're on this idea right now where it's going to be a downward trend in the stock market, and you can use real estate to really level out your investments at this time. But this is nothing that we haven't seen before. And so if you draw out and you look at everything from a bird's eye view and you see the big picture, just keep staying the course. So whatever it is that you're doing, be smart about it, right? But if you're investing in the stock market, stay the course. If it makes sense to stay the course, have those conversations with your financial advisor. Don't do anything that's rash, right? Don't pull all of your money out of your small bank just because you think that it's going to go under, when likely it's not going to. There's so many times when there's just fear being thrown in our faces, especially if we watch the news and go through everything. But ultimately, we've just seen this roller coaster over the last 100 years, and it does the same thing all the time. It just feels different because, one, it's probably new to us, and two, we haven't taken a bird's eye view to look back at the history.
Well, I'm gonna plug in something right here because you mentioned it. This is the best time ever in the commercial space. Because what happens, the interest rates went up and they created a void. People that took loans on variable, and a lot of builders did that, now they're coming due and they have to sell. And pretty much because of the new interest rates hike, every percentage difference, let's say, I'll give you a direct example. Let's say they got the loan at 4% initially, and now the cap rates are at 6%. We can't get a loan under 6%, that 2% difference represents about 30% discount on the selling price. Mm-hmm. The seller has to match that number, and he's losing value, and he's selling the property at discount. So pretty much increase value. And this is where the opportunity comes for new investors to come in and scoop up properties that are discounted in this market. I'm talking about new construction, older construction. Like you said, this is a happening right now. We're definitely taking advantage of the situation, the scenario. 6 months or a year from now, we have no idea what's going to happen. They're exactly. Going to even out. It's a unique opportunity in the history of real estate and commercial space.
That's exactly why I'll be following you, because you keep up on the nuances and the trends of what's going on in the market and commercial real estate. And if you're not following people like you who are up to date on the knowledge, there's just no way that you could make an intelligent decision about what to do.
I appreciate it. I'm doing this from two perspectives. One, I'm a syndicator. I work on an active team. And two, I'm an investor. I'm putting my money where my mouth is. I'm putting my money into those deals. And I'm so eager in learning about the process and everything else, the ins and outs completely, because I'm an investor. I have my money in it, and I work with the same exact tools that everybody else. I don't have a 401k, as you already know. I have an annuity and I have a pension account that I want to transfer over, and I was weighing my options with you. That's why I needed expert advice. And I'm also selling one of my properties right now to invest the money into the commercial space because I want to take advantage of this opportunity. There is a lot of opportunity in the single family space too, as well. It's just the interest rates there are very competitive.
Mhm.
And it's going to make sense. Eventually, when these interest rates are going to go down, real estate is going to go back up to where it was. Randy, I thank you very much for your time. I really appreciate it that you accepted my challenge, and I'm looking forward in talking to you again. And yeah, why not? Why not? Why not call us and give us a call and then see exactly how we can help you out reach your financial independence and your passive income goals. Thank you so much, and I really appreciate it. Have a great day.
Thank you, Silvius.
Thank you. Bye-bye.